All right, good morning, everybody, and happy Monday. Just quickly make sure you guys can hear me okay. Yeah, it sounds good. If you want to quickly confirm to me, if you don't mind, if the audio and visual is working for you, that would be great. And then we're going to get started here for something very important here on a Monday morning. It's going to be a busy week ahead. I think that's been well telegraphed for markets. So we'll get started here in just a second. I typically like to start about 2 minutes past the top of the hour. That gives people a little bit of time to get in here. And thank you for the confirmation of audio visual. That's good to know. Very good. Do you guys all have a good weekend? A busy weekend, yeah. Yeah. All right, very good. Maybe just one more minute. If you're here for the first time, what we're doing here today is this is our Set the Market morning show from thesteadytrader.com. And what we do is we go through the top few things on the notepad. And this morning there's a very specific idea I'm going to go through. We do this morning show Monday through Thursday, so it's really important that you get alerted on these things. I'll talk to you more about this in just a minute. Before we get started here, it's just another few seconds to go, and then we're going to get started. Also, if you want to invite anyone along to be here for the morning show today, or certainly going forward, please make sure you spread the word and pass along the YouTube link to our YouTube channel. All right, it's 2 minutes past the top of the hour. Again, good morning, everybody. Serge Berger here from thesteadytrader.com. It is Monday, the 31st of March, and this is our Set the Market morning show. Now, we have a very big week ahead, okay? And we are supposed to be getting some big news on Wednesday, April the 2nd. And and what we're supposed to be getting is basically tariff news. So I think everyone here, for the most part, seems to be aware what Liberation Day is. That's not my term. It's President Trump's term for Tariff Day on Wednesday, this Wednesday, April 2nd. And typically speaking, during this morning show, we go through the top things on our notepad. This morning, the notepad is really about this. And there's a very specific trade idea that I would like to share with you. I want to be very clear that none of this is a recommendation. All this is purely educational. So that's really important to understand. Now, before we get to anything, let me just quickly make sure you understand that this trade here that I'm about to show you is actually one I went live on Friday, so just a couple days ago on the YouTube channel. So I'm going to quickly share with you, if you go to our YouTube channel, which you are on, by the way, right now, since you're watching this, and you go into the live section, you see that last Friday on the, whatever the day was it the 28th of March, we went live and we actually talked about this trade. Now, a few days have gone by, markets are down even more, so it's really time now to talk about this and make sure everyone's aware of what the opportunity set is. So if you didn't get this trade on Friday, the first thing you need to do right now, okay, you take your mouse and you go down on the bottom of the screen here somewhere or of the YouTube thing where it says subscribe to the channel. Okay, that's really, really important. And also please like the video. That would really help us to make sure that we can continue doing this going forward. Okay, so that's the first thing you need to do, because once you subscribe to the channel, you get alerted in real time when we go live with things like these here right now. Okay, so please everyone do this right now and let me know when you've done it. And then we're going to start and we're going to look at the specific opportunity here today for this particular week that we like. Okay. All right. Very good. And then we'll get started here in just a second. So, okay, very good. So what's the opportunity? So what we have this week is we have something called a known unknown event. okay? And it's supposed to be taking place on Wednesday, April 2nd. Again, this is all coming out of the White House, right? And what is supposed to be happening on Wednesday is this announcement of tariff, more sort of a bit more maybe specific what the tariffs are going to be. You can see over the weekend the markets have reacted lower, meaning the futures market this morning is seeing the market down, and so the market's clearly nervous about this. And so what I'd like to share with you today is, and again, we did this already live last Friday. I'm assuming most of you didn't see it because you didn't subscribe to the channel. That's why it's so important that you please do so. Please do so right now. Share it with everyone you possibly can who would be interested in this as well. This is our morning show. We do it Monday through Thursday, exactly like this here. So let's specifically get right to the trade idea so that we can stay on time here. Now, when we look at the market and we look at specifically the S&P 500, which is what this trade is on, we will notice that, of course, the S&P is actually down on the year. This is the SPY ETF. So the specific idea here, again, not a recommendation, it's a trade idea, meaning it's purely educational, is that we're going to expect a move in either direction on Wednesday that's pretty big. Now, because we don't know what the outcome is going to be, what we have on Wednesday, again, that's this Wednesday, is what's called a known unknown. Have you guys heard of what that is? A known unknown. So we know the date, and we know roughly what's going to be announced, like the topic, but we don't know the outcome, right? So that's really important. So we call this a known unknown. So basically any economic report, any earnings report falls into in this category. This one here, however, I would say is probably well above average in terms of how much it could move the market. And even if it doesn't, it's not like this is going to blow up someone's portfolio, the trade idea I'm going to show you here. So essentially what we're expecting on Wednesday, I went as deep as I could over the weekend to find out what time of day this tariff news might come. Again, they're just floating this out there. It's supposed to be at some point in the morning, I guess Eastern time, coming out of the White House. So essentially what I would expect is some sort of a move in either direction that's pretty big. And what it allows us here is to put on a trade that essentially could be profitable if the market moves significantly enough in one direction or another. Now, I will preface this by saying that I actually typically don't like to do this kind of a trade too much, because typically speaking, the options market is priced to a point where it becomes very difficult to make money with this. In this case, I actually think the options market may not be pricing it enough. And so very specifically what we're going to look to do, I'm going to give you the math here in just a second, is to do what's called an at-the-money straddle. If you've never done an options trade before, it's actually a very simple thing to do in terms of conceptually. All we're looking to do is essentially buy a call option at the more or less the current price of the market, and then a put option at the current price of the market, so that we could make money in either movement in either direction. But again, what's important is that the market does have to move enough in one direction or another in order for us to make money. And most of the time, whether it's an earnings report or some other known unknown event, the market actually ends up not moving enough for a straddle to make money. In this particular instance, for me personally, I think there is a decent chance of the market actually moving quite a lot, maybe more than expected. And if it doesn't, it's not going to be like a disastrously horrible trade. If we do this too. So the point here would be to be doing a straddle. Okay. Now, whether you like this trade or not ends up being up to you. Again, obviously not giving you a recommendation. I don't know you. I don't know your portfolio. This is purely educational, but I think it's a really interesting idea in this particular instance. Now, what's important is the details. So first of all, let's understand how much is the market currently expecting to be moving. And so in order to do that, we need to go into the options market. So we're looking at the SPY ETF here. And what I'm going to do is I'm going to open up the options chain that I have here. I'm going to make it as large as I possibly can without making it annoyingly large. So I think something like this should be able to show you. So currently, and this is important, so the S&P 500 or the SPY ETF closed last Friday at 555. This morning, when I'm looking at the pre-market, the futures market is essentially pricing the SPY somewhere around 550, about 550. So I'm just going to go for illustration purposes and use the closing prices from last Friday. The S&P is down, what, like about 1% here pre-market from what I can tell. So I'm just going to use last Friday's prices because it's you know, it'll be close enough. I'm going to put it this way. So that's what we're going to do here. Now, in order to do the math of how much is the market pricing in that the S&P might move on by the end of this week, we have to take what's called the at-the-money straddle and price it. And so what I'm going to do is I'm going to use the options, and please pay close attention here, because there's a nuance here that I think a lot of people typically don't do with this kind of stuff. That's why they end up losing even more money than they should if the trade doesn't work, and it's a small loss if the trade doesn't work. What we need to do in order to price it, or meaning figuring out how much the market's likely to move, is we need to take the closest. I like to use the weekly options expiration to price that. However, the trade itself, we're not going to be using weekly options for a specific reason, which I'll tell you in a minute. Okay? Now, the market closed at 555, or the SPY did last Friday. So if I want to see how much the market is pricing, or the options market is pricing the S&P to move by Friday, I need to take the at-the-money call price and the at-the-money put price and add it together. Okay. Now these are last Friday's closing prices, and I'm using the 555 level. The market currently is pricing pre-market trading around 550, but you know, by the time we get to the market open, who knows? And I just want to give you a specific example. So if I take the roughly $7 of the 555 put plus the $7 that the 555 call option costs me, so that's 7 plus 7. Even though I can do that math, that's 14. Okay, I'm going to round it up to 15 just to make it even simpler. So 15 points in either direction is what currently the options market, as of last Friday's close, is pricing the S&P to move by the end of this week. Okay, that's 15 points. Now, if I take the current market price, or last Friday's market price, and I take 15 points to the upside, that gets me to about 570. So 570 on the upside, and on the downside, 15 points from here is about 540. So I'm going to give you the visual here, and what I'm trying to show you is that the market is essentially thinking that the S&P 500 is going to move within this zone. So the S&P is essentially being priced currently that it's going to move somewhere up to 570 and somewhere maybe down to as much as 540. Okay, that's what the options market's currently pricing. Give me a quick thumbs up, a like, or something in here to make sure you understand this part. Okay, this is important. So what I'm saying, I'm betting on, is that the S&P 500 might actually move more than that, particularly on Wednesday. Okay, so that's why an at-the-money straddle here, using options that are going to expire a bit further out. So we're not going to use weekly options to trade this, but I need to price it using this. Okay, so are we good so far? Okay, very good. So now that we know how much the market could move, we now need to see which options could we take. Again, I don't want to use weekly options. Why do I not want to trade options expiring this week, this Friday? Okay, very simple reason, but extremely important. So write this down, please. Take a pen, take a piece of paper, and write this down. The reason I don't want to use options expiring this Friday on the 4th of April is because if the market doesn't move at all, so let's say the market does absolutely nothing on Wednesday, which again, I would argue that's unlikely, but it could happen. I just don't know, right? That's the point. The point is we don't know. But if it were to do that, and if it were to just literally just go flat, and I'm going to zoom in a bit more so this becomes a bit more better to see. So if it were to just literally go sideways, If I used options expiring this Friday, what would happen is the implied volatility, which is currently, let me see what the implied volatility is. Currently, the implied volatility is about, I'm going to say, about 20. Roughly about 20 is the implied volatility, okay? So it's the same options expiration that we're going to use and the same option strike, but we're going to buy both a put and a call, or both a call and a put. Okay, now I'm going to give you another math here in just a second so you can really get your head around this. But the reason that I don't want to use options expiring this Friday is because if the market doesn't move, the implied volatility is going to go down so fast that both of my call and my put are going to lose more money than they otherwise would, okay, if I use options a bit further out. Does that make sense? This is really important. Also, what's going to happen is time decay is going to completely just crash these prices. So because if I were to use options expiring this Friday, which have a huge time decay, by the time this trade is over and ready to be exited, let's say either later on Wednesday or maybe Thursday morning, the time decay will also work against me really badly. Right? Does that make sense? Okay, this is a really important concept. That's why I'm such an opponent of using these extremely short-dated options, because there are things embedded in those options that a lot of people haven't experienced before, and they're now in this type of market environment going to start to realize how dangerous short-dated options can be if these things are not being priced, taken into consideration. Now, before we get to the specific trade using options that expire a bit further out, then we'll get to this. Let me show you one more thing. So what I'm going to show you here is we're going to add something called the average true range. Okay? Is everyone familiar with an average true range? So what the average true range is, it's giving us a 14-day average of the daily move of, in this case, the S&P 500. So you can see over the past 14 days, the S&P 500 has moved about 9 points up or down each day, right? So if I were to so that's 9 days. That's over the past 14 days, that's been the movement. But in this case, the market has to move more than 15 points in order for me to make money in either direction. Actually not as much, but maybe more like 12 points. But let's just, to be very conservative, go with 15 points. It's probably less. But if I take the 9 points that the average true range has been over the past 14 days, I don't think, given given how big the news event may be on Wednesday, maybe, again, we'll find out, I don't think expecting the market to move 13, 14, 15 points is that crazy. Does that make sense? Right? So already on any given day over the past 2 weeks, the S&P has moved about 9 points per day. In this case, all I'm saying is that I think it might move 13, 14, 15 points. Now, that is more but I think given the news, it's not crazy to believe. Okay? Does that make sense? You guys understand that part? Right? Now, so that's the average true range. So we've given you the rationale for the trade, which is the tariff day, or they call it Liberation Day. We've talked about how to actually consider this a known unknown event, right? Then we've talked about how to measure how much is the market supposed to move. Are you guys learning something here? It's really critical. So if you like this kind of stuff, make sure you subscribe to the channel. Make sure you show it to everyone you possibly can, because this is stuff that we do in here, right? Now, let's get to the actual trade. So we've talked about not wanting to use weekly options because of the time decay and because of if the trade doesn't work and it just goes sideways, what happens is the implied volatility gets crushed. Let's talk about implied volatility. The easiest way to show you the implied volatility is by showing you the VIX. Okay, and the VIX as of last Friday was trading 24. And so essentially what is going to happen if the S&P were to just go sideways is that the implied volatility would go down. Because when you buy an option, a call or a put, you're buying the value of the option has implied volatility embedded. So if I buy an option that has a high implied volatility, which we're not buying like crazy expensive options here, but they're not cheap, right? But again, we're taking advantage of the situation I just described over the past 20 minutes here. So once the event is over, the implied volatility is going to go down, and it's going to be worse with short-dated options. So instead of using options expiring this Friday, what we want to do is we want to use options expiring a bit further out for all the reasons I just mentioned. So what I'm doing here, and I'm going to price the trade for you guys here right now. Again, this is using data from the market as of Friday afternoon. We're here close. We're here Monday morning. Market's opening in 10 minutes. So I'm going to give you the trade as of those ideas, as of those timeframes. Now, what I'm going to prefer to do is probably use options expiring on April 17th, which is the monthly options expiration of the month of April. Those options expire in 17 days from now. Now, that's also pretty soon, but it is not as bad as using weekly options. What's the time frame for this trade? The time frame for me is whenever they announce this stuff, which is supposed to be at some point Wednesday morning. That's what they say. Nope, not my words. We'll find out. I don't know. As soon as we have news and the market reacts to it, I'm going to expect that this trade would be something that I can exit on at some point on Wednesday, if not Thursday morning, right? Now, we're going to go live on Wednesday as soon as the news hits, and you guys need to be alerted. I'm going to give you a link where you can register so you get alerted in real time. Because we're going to go in GoToWebinar because we can't alert people as quickly on YouTube Live. So I'm going to give you guys a link here in about 3 minutes that you need to go to, put your name and email address so you get alerted in real time on Wednesday when we go live. As soon as the news hits, we're going to go live and follow it. Okay? Are we good on that? Now, the specific trade is this. Again, we're not going to use weekly expiration. That's for all the reasons I mentioned, not the thing to do. What we want to use in this case, what I want to use more specifically, is options that expire on the monthly options, April 17th, and I would look to buy a 555 call and a 555 put. Currently, that trade with one options contract as of Friday's close costs about $21.12. So that translates into $2,112 per contract. Okay? That's the cost of the trade. So let me show you what it looks like. So if you look at the risk profile, which is this, you can see that the market has to basically move either up or down by, again, it's actually not as much as I said before, but I'm trying to be conservative and show you as long as the market moves, I'm going to say towards 570 on the upside or on the downside towards 540, this trade stands to make money. The more it moves, the better, obviously, right? And you can see, so you want to follow the purple line here. The line that is, I guess, teal or blue is the at expiration. So just focus on the purple line, okay? So again, it's an at-the-money call straddle, which means one would buy an at-the-money call and an at-the-money put using April options. And it costs $21.12 right now. Again, the market, this is last Friday's closing prices. So that's what we're thinking here. Now, let's talk about the risks to this trade, which is paramount of importance to understand. The risk in this trade is that if the S&P doesn't move, or it doesn't move as much, maybe it moves just 1% up or down, which is possible. I don't think so, but it's entirely possible. You have to be open to that. In that case, both the call and the put are going to start to lose some premium because the implied volatility will come down. And so it won't be catastrophic. It's not like it's going to go to zero, but it'll come in a little bit. The reason we're using April 17th options and we want to get out of this trade by later Wednesday or maybe Thursday morning, again, we'll go live on Wednesday to talk about all this once we have the news, is because of the time decay. Because if we use options that expire a couple of weeks out, again, the April options have, the April 17th options have 17 days left to go. So we're buying both a call and a put. So clearly that's going to be a debit. We're buying, not selling. We're buying a call and a put. Look at it right here. Look at it on the screen, right? We're buying a call and we're buying a put. That's why we have a straddle. It's an at-the-money straddle. Does that make sense? Okay, now we're actually going way past our usual time. Usually we go about 15 minutes. Here's what you need to do right now. This is a long straddle, okay? You buy a call and you buy a put. right? You buy a call. So when you buy, you're long. So you buy a call and you buy a put. So the idea is to buy a call and buy a put. Again, not a recommendation, purely educational, at the 555 levels using the April 17 options. Okay, are we good? Now, what you need to do right now is the following. If what we're gonna do on Wednesday, when as soon as we have the news, we're gonna go live. Okay, and what you need to do right now is do this. You need to go to this link right here. I'm gonna put this into the chat box. Let me quickly put it here. You need to go to this link, and you need to put register there. Just put your name and email address in there, because that way you will be alerted. This is going to be where we actually follow the news. Okay, so make sure you go there, because otherwise because once we have the news, we're going to go live immediately. All right. We good on that? So www.thesteadytrader.com/Trump. All right. And then what we're going to do is we're going to go live as soon as we have the news. Okay. If you don't like the trade, don't do it. Right. It's pretty simple. It's as simple as that. What we're trying to do is we're trying to teach you an idea here with everything I just mentioned for the past 25 minutes, why I think in this particular case a straddle makes sense. I'm actually not a big fan of straddles in general, but in this case I think it makes a lot of sense. Okay, so you go to thesteadytrader.com/Trump and you register, because it's going to be real quick, right? We can't, as soon as we have the news, we have to go live pretty quickly to follow up on the trade. Yep. Excellent. Now, here's the other thing you have to do, because an email may not be fast enough. What you need to do is if you want to get a text message on this, because remember, once we have the news, it's going to be quick, and we're going to go live and analyze the market exactly as soon as we go live. If you want to get a text alert, you need to go to this link as well, right? So you have to sign up to both, because we can't send you a text alert unless you sign up separately. So this is all free, by the way. We're not charging anything for this. So if you want a text alert on this when we go live, so you know, right? So you might not be on your computer, so you might want to get a text alert. Then you go to thesteadytrader.com/SMS. Yeah. So the question is, when would you do this trade? I mean, again, we're not giving you investment advice here. I personally am going to probably enter this trade here, I don't know, in the next couple of hours. I don't think I'm going to do it like right at the open, because Monday morning open is always a bit of a thing. But it's actually really important that if you like this trade, that you join us live on Wednesday, where we are going to follow up on this, right? It's really critical. So the point is to position for the trade now, not like this second here, but like, at some point, maybe this morning. And then follow up. It's critical, right? This is a very timely trade. It's what we know, a known unknown event, meaning we know the date, but we don't know what the news specifically is in terms of the intricacies, and we don't know how the market's going to react for sure. Okay? Are we good on that? So please make sure. So again, two things. To register for the actual event, which we have to do in our webinar software, because we can't go fast enough on YouTube Live. So you have to go to thesteadytrader.com/Trump, and then to sign up for the text messages, so you actually get an alert by text message when we go live. Then you go to this. So we're waiting for Wednesday's tariff news to hit. Once we have the news, we're going to go live. Good? The other thing is, if you want to do the trade live with us throughout the day, positioning today, and then of course Wednesday and on forward, make sure you join us in our trade ops room. So you go to steadytradersecrets.com/ops. You can go there and join us in there. So that's our live sort of trade room where you can join. But more importantly, right now, to join us on Wednesday is to register with this link, thesteadytrader.com/Trump. And then for the text messages, it's thesteadytrader.com/SMS. No, TS long. No, the point is to open the trade now. Again, I'm not giving you a recommendation. I'm just telling you what the basis of the trade idea is from an educational perspective. The idea is to enter the trade now, not this second, but maybe at some point over the next hour or two or something like that, right? It's a straddle. Straddles, yeah, we have to position for the news. Because I don't know, maybe they're going to actually do this event before April 2nd, or maybe there's some major news in between. I don't know. The point is to take advantage of the known unknown situation that we have. Okay, so make sure you do this. Now again, it's important that you actually sign up for the webinar, so you register for that and for the text message. Otherwise, you might not get it fast enough. Very good. Okay, I'm gonna get into the trading gear right now. Has this been helpful this morning for you guys? Give us a thumbs up, like. Again, very importantly, please subscribe to the channel, because if you don't subscribe to this channel, you'll never be able to join these kind of things real time. Now, Wednesday's live session we have to do in our webinar room, because we have to we can't be quick enough on YouTube Live. So that's why it's important that you register for the text message quickly, so you receive that alert when we go live, and also, of course, for the actual session itself, so you can be there. All right? Very good. Thank you, everyone. We'll see you guys at the latest on Wednesday in the session. And hopefully this is helpful for you all. Again, make sure you sign up there, and both links are in the chat box. And we'll see you on Wednesday. If you're a Trade Ops member, we'll see you in the chat rooms here shortly as well. Thank you, everyone, and we'll see you on Wednesday. Thanks for being here.